when prices lied but behavior didn't. Everything looked fine on the surface. Charts held steady. Indices hovered near familiar levels. If you only watch prices, nothing seemed wrong. This story matters now because markets often mislead those who focus only on outcomes. Prices can remain calm while behavior shifts underneath. And when behavior changes first, price eventually follows, often violently. To understand how a major shift began while prices told a reassuring story, we need to look at the moment behavior started contradicting the chart. The chart is a record of transactions that have occurred. It tells you where the last buyer and seller agreed. It does not tell you how many buyers remain, at what price they will withdraw, or whether conviction that produced past trades still exists. All of that lives in behavior, in the decisions that have not yet been expressed as prices, but that will be the moment conditions shift far enough to force them into the open. It began during a period of apparent stability. Volatility was low, ranges were tight. Commentators spoke confidently about balance and control. The market appeared to be digesting gains in an orderly way. Nothing suggested urgency. But beneath that calm, behavior told a different story. Traders stopped pressing winners. Profits were taken earlier. Risk was trimmed faster. Positions were treated as temporary, not directional. Moves that once invited conviction now invited caution. The market was still moving, but nobody wanted to stay. The first reveal came through participation. Volume thinned during advances. Rallies were carried by fewer players. Depth appeared briefly, then vanished. Liquidity looked healthy until it was tested, then retreated without warning. Institutions noticed before headlines did. Risk committees met more frequently. Exposure was reviewed daily instead of weekly. Models still worked, but only barely. Small changes in assumptions produced outsized differences in outcomes. What made this moment dangerous was a contradiction. Prices suggested calm. Behavior suggested retreat. The two narratives coexisted, and most people trusted the visible one. But markets are driven by decisions, not charts. And decisions were already changing. The most telling sign was how quickly confidence evaporated during minor stress. Small pullbacks triggered defensive moves that felt disproportionate. Not panic, precaution. The system wasn't afraid. It was unwilling. Unwilling to assume continuity. Unwilling to trust support. Unwilling to believe price told the whole story. Prices were calm because activity was shrinking. And shrinking activity doesn't show up immediately on a chart. It shows up in hesitation, in shorter holds, in faster exits, in silence where conviction used to live. When prices lie, behavior tells the truth. And behavior was already preparing the market for something price had not yet admitted. As behavior continued to diverge from price, the gap grew harder to ignore. The market still printed stable closes, but participation kept shrinking. Fewer trades carried weight. More movement came from absence rather than intent. The reveal deepened when liquidity began behaving asymmetrically. It appeared instantly during calm moments, then vanished during even mild stress. Orders that once filled smoothly now slipped through gaps. Execution felt uncertain, even when price looked controlled. The early conflict emerged inside risk systems. Models flagged inconsistencies that charts couldn't explain. Drawdowns remained small, yet recovery assumptions weakened. Time to exit stretched. Costs increased. The risk wasn't direction anymore. It was escape. Institutions adjusted quietly. Exposure caps tightened. Position turnover increased. Trades were structured to survive being wrong quickly rather than being right slowly. The market still offered opportunity, but only to those willing to leave early. This was the hidden transition. The system moved from conviction to contingency, from belief to protection, from trust and structure to reliance on reflex. The most dangerous signal was how fast behavior changed during stress. A minor dip triggered widespread caution. Selling didn't surge, but buying disappeared. The market didn't fall. It hollowed. Prices remained calm because activity withdrew, not because balance was strong. The chart suggested stability. The tape revealed reluctance. And reluctance, when shared broadly, becomes pressure waiting for release. The market wasn't mispriced. It was misread. Because prices only tell you where the last trade happened. Behavior tells you whether anyone is willing to stay. And fewer participants were willing to stay for long. The pressure finally surfaced when the market encountered a moment that required belief. Not a shock, not a crisis, just a situation where someone needed to step forward and commit. No one did. The conflict intensified immediately. A modest move extended further than expected. Buyers hesitated. Liquidity thinned where it had always appeared before. What should have been absorbed cleanly slipped through gaps left by retreating participation. Prices began moving on absence rather than intent. Not because sellers were aggressive, but because buyers were gone. Each small decline reinforced caution. Each hesitation validated the decision to step back. The system wasn't panicking. It was withdrawing. Correlation rose quietly. Assets that once offset risk began moving together. Diversification failed without drama. The market had already synchronized behavior long before price reflected it. Inside institutions, alarms finally grew louder, not because losses were large, but because assumptions were breaking. Exit timelines stretched. Execution costs ballooned. Risk models no longer trusted calm prices as protection. This was the moment the contradiction became undeniable. Prices had been lying about stability. Behavior had been telling the truth all along. The buildup reached its most dangerous phase when reflex replaced analysis. Decisions were made faster, not because of urgency, but because staying felt unsafe. The market became reactive rather than intentional. No headline marked the shift, but everyone felt it. The realization spread quietly across desks and screens. The market wasn't fragile because of bad news. It was fragile because belief had already left. And once belief leaves, prices don't fall because of information. They fall because there's no one left to argue against them. The climax arrived through recognition rather than collapse. The market finally accepted what behavior had been signaling for weeks. Stability on the chart was no longer evidence of strength. Prices adjusted quickly once belief was gone. Not violently, efficiently. Liquidity returned selectively, but only after repricing made participation feel safer. The system reset without panic, but without denial. The resolution unfolded through honesty. Risk was reassessed. Time horizons shortened. Exposure was rebuilt slowly, deliberately. The market stopped pretending calm prices meant calm structure. In hindsight, the warning had been persistent. Behavior had spoken clearly. It had said commitment was gone. That confidence had thinned. That price was being supported by habit rather than belief. Modern relevance is constant. Today's markets still reward those who watch behavior instead of charts. Still punish those who trust price without questioning participation. Still shift long before headlines catch up. The lesson is simple, but rarely followed. Prices are a snapshot. Behavior is a trend. And when the two disagree, behavior always wins. Because markets don't move on what they show. They move on what participants are willing to do next. Subscribe to join the journey. The practical implication of this divergence between what prices show and what behavior reveals is that any participant who relies exclusively on price-based analysis is, in effect, reading yesterday's decisions rather than anticipating tomorrow's. Price is a lagging indicator of the decisions that have already been made. Behavior is a leading indicator of the decisions that are about to be made. The gap between them is where genuine insight lies, and where genuine risk concentrates before it becomes legible to those who only watch the chart. Developing the capacity to read behavior requires a different kind of attention than reading price. It requires noticing absence as much as presence. It requires asking not just where price is, but who is holding it there and how committed they are to staying. It requires treating the texture of execution, the way liquidity arrives and departs, the speed of exits, the reluctance to extend, as information as important as any data release. These are not skills that scale automatically with experience. They must be cultivated deliberately, maintained consistently, and applied especially when prices are calm and the temptation to trust a visible narrative is at its strongest. Because the periods when prices lie most convincingly are precisely the periods when behavioral attention is most rewarded. When